the Ryanair CEO, he's so quiet and meek. Yeah, let's brace ourselves. It's often firing, isn't it? Firing, of course, with the head of Ryanair. That's going to be a lot of fun. What else? No, carry on, Fran.
Yeah, so last time I spoke to him, he said that he surprised all passengers by being at the gate and checking them in. So I can't wait to see how he arrived, back in Ireland and who was on this highway. It's never dull, and I know he's in the conversation on Brexit. He never ever holds back to talk about Brexit or anything political, so it'll be interesting to know what he says about that.
Yeah, that is going to be a really critical conversation, isn't it? And you've also been talking healthcare, supply chains, post-pandemic, what's happening with the vaccine makers. What else has kind of really stood out to you as we just kind of start and edge into the beginning of this event?
Well, we look at global supply chains, and we had a good conversation with one of the vice presidents at AstraZeneca, Pam Chen. She says she's worried, certainly in her field, which is healthcare and biopharma, that as geopolitics gets more fraught, as we have a lot of domestic input to try and get some supply chains back home, that actually all this globalization ruptures. Now, what this means for the production of vaccines, but also how you ship vaccines across the world, could have huge implications for her industry. Now, it's interesting also to get her thoughts on the Inflation Reduction Act. And I know we'll spend a bit of time here speaking to big chief executives of financial firms about not only the debt ceiling in the US and what that means for markets and what that could be the implication longer term, but the Inflation Reduction Act. So this is, for example, Ireland. If you look at how much more direct investment we've attracted, $9 billion last year, 70% of that is from US investors. Does that money go back to the US instead of coming to Europe because of the Inflation Reduction Act? Again, they're trying to do everything when it comes to help with climate change, research and development and the like. So these are just some of the good conversations that we're hoping to have here in Ireland.
Okay, excellent stuff. Lots, of course, to work through in terms of big topics of the day. Francine, now for us, of course, just outside of Dublin. We'll be crossing back to Fran just in the next couple of minutes. Let's get a pre-market check on Tesla. Because guess what? As forecast, they have cut prices again, second time this year in the US. In terms of the models, we're talking the Model 3 and the Model Y. And this, again, a reminder that this is a company that is prepared to sacrifice its margins on the altar of market share. Pre-market, Tesla down 1.6%. So just as an example, on the Model Y, again, this is stateside, we're looking at a drop in terms of prices of 5.6% to just below $50,000 US. Again, the margin is going to be squeezed and hit on the back of this, but it's about maintaining and expanding market share. And this is driving a lot of pressure across the auto space. Others having to respond with their own price cuts. We'll keep across the story for you. Of course, currently down 1.6% pre-market. Let's check back in on Netflix as well. Originally, after the from these, when they laid out a scenario where things will improve, the expectation, of course, for Netflix as they crack down on password sharing. They think there's about 100 million people who do not pay for access to the services. They crack down across the various different jurisdictions. They think they're going to get those subs back in. And then you saw that big pairing drop. We're currently down back 1.1% on Netflix. But again, it was a sharp drop of 12% straight after. It was a little bit of coming through in terms of forward guidance then on Netflix. But checking in on two of the big corporate stories. Morgan Stanley, of course, on the banking front is up later today. Really interesting, but he's focusing on the fixed income part of that business after the disappointment of Goldman Sachs. Meanwhile, on Netflix, reporting to say earnings rates subscriber gains for the first quarter. The streaming giant says it is expected growth in the second half of the year. Again, down on. Some tech analysts, they say the company should stop focusing on sub numbers like this.
腰痛改善で痛みが戻る、そのだけしか改善しないって悩んでる人が、もしそんな人であれば、今回ですね、Advertising becomes an important revenue. Essentially, advertising the mix, I think they have to drop just subscriptions because it's going to change the overall picture from a revenue perspective for them. So yeah, I mean, people are still going to look at it for the next couple of quarters, I think, but over time, I say by this time next year for sure, it's going to be a revenue.
I think I'd be more interested in profitability and the fact that we're in a year where we're comparing against still some COVID impact in different parts of the world. I would say that we need to stop focusing on the subscription growth and really focus on, as I said, free cash flow growth.
All right, so commentary there on those Netflix earnings. Let's listen in now, of course, back to what's happening in Dublin discussions at the new economy gateway just outside of the Irish capital. Eric Chasker is speaking to UniCredit Group CEO Andrea Orchel at the forum in a moment. We will be crossing over. You can see Eric Chasker there on stage. Important in terms of the conversations coming up around the banking space, of course, in Europe. You're speaking and hearing from the CEO of Italian lender UniCredit. In terms of the banking stress, credit conditions, of course, the loan requirements, and to what extent asset quality is holding up in this environment. It's worth checking in the markets at this point because to point out that European stocks are down 0.4% is really missing the story at the moment, which is repricing in UK assets on the back of double-digit inflation. The high inflation story, of course, is what's happening in the banking space. But briefly, let's check in on yields there. You're looking at a move significantly higher in terms of yields at the front end, 12 basis points. At the front end, the 2-year 381, at the back end 382. So look at that bear flagging there. 2-year 381, 10-year at 382. The pound, we'll have a look there as well. There's a pop versus euro versus US dollar. Again, double-digit inflation remains the story in the UK. It's not the story in the US. It's not the story in the Eurozone. It is the story here, though. There are political consequences of this, and there is, of course, the response from the Bank of England as markets now price in rate hikes, not just in May, but also in June. A reminder that the rate here for the Bank of England is currently at 4.25. Markets now expecting you're going to get to 5%. How much damage does that bring to bear on the UK economy? And what does it mean politically as well for the government of Rishi Sunak? They're around 1.23, 8.6%. Now, HSBC, they are targeting 30 in that direction. Let's cross back to Francine on the ground, just outside Dublin, ahead of this. Francine.
Yeah, Tom, I'm looking forward to hearing Eric Chasker in conversation with Andrea Orchel. This will be the first time that we hear from Andrea Orchel since the banking crisis, actually in a public forum. So I think some of the things that Eric will try and get out of him is, first of all, how he lived through the month of March. So you're a global chief executive, but based in Italy, which means that you're much closer to the banking crisis in Switzerland. So what did it feel like when SVB went down that Friday night? Was he really trying to follow what's happening in the US in terms of deposit guarantees? Because that has a huge read across for the European banks. So it'll be really interesting to also see whether the fact that now Switzerland has only one major bank with essentially cutting off some of the other investment banks, whether it still means that Europe, and I know this was previously, certainly when he was at UBS, one of his big dreams, that Europe would have an investment bank strong enough to rival some of the Wall Street titans markets. So if you look at the context, you have JP Morgan with some pretty incredible results. You have the same for Bank of America. Morgan Stanley doing really well. With the consolidation now, Credit Suisse and UBS, where does it leave European banking? Do we need a national champion, regional national champion to try and service some of the clients so that it takes a bit of market share from the US? So I think they'll focus on that. And then just in general, where he sees interest rates and what that means for his business model and deposits. We saw, and Tom, we were talking about this on air yesterday, the fact that Apple with Goldman Sachs has this new deal where actually you get 4.15% on your deposits. How does that change all the European banks?
Really, really interesting point. Let's listen in now to those discussions and hear from the CEO, of course, of UniCredit, speaking to UniCredit Group's CEO, Andrea Orcel, with some of those questions that Fran flagged to the chief executive. Let's listen in to the forum. Move on, you're coming for just outside Dublin.
Andrea, it's awfully good to see you. Thank you. Very nice to meet you. I'm going to remind you that just 6 weeks ago, it seemed like the world was barreling headlong into another banking crisis. There was a real sense of panic. There was a historic flight to safety in the treasury market. I want to know, what was it like running a bank and worrying if this wasn't 2008 all over again?
Well, I think that obviously when you see shocks like this one, and not one, but more than one, at the same time, you question whether you're missing anything. And then you review everything that you're doing and you're saying, well, can it happen to me and what's different? I think that the conclusion is that these were isolated cases. They were pretty much idiosyncratic. They highlighted that regulation, in my opinion, needs to be applied consistently across not only banks of various sizes, but also all financial intermediaries. And that you do not need to stop at rules, but also look at the principles that are backing those rules and see whether institutions are managed in the way they should be managed. That is the key question at the end of the day. Today, we wish to have a knee-jerk reaction and add more rules, more tightening, when the banks, especially the Europeans, who have been submitted to those rules, actually do not have those problems because those rules have worked.
Silicon Valley Bank failed on a Thursday night. Within a couple of days, Credit Suisse had been forced into a shotgun marriage with UBS. How long after that, and of course Signature Bank also failed that Sunday night back in New York, how long did it take before you felt like everything's going to be okay?
Well, I think there's a general question that any time you dent trust and confidence into a system, then you worry. Because at the end of the day, banks are built on the trust and confidence. So that for me was the key issue. Is the broader market not understanding exactly what triggered the situation, going to say we have an average 2008 and therefore all the banks have the same issues? And the market reaction was exactly in that direction. But when you look at the issues that triggered that, case for example, in the US, liquidity, interest rate mismatches, and we just would not be doing that even if we wanted to, we do not want in Europe. So it does not apply. What applies is a read across that affects confidence. So let's say that we were convinced that we were in a solid position quite quickly. What we were worried about is the contagion by the lack of trust of confidence. I think that the ECB just keeping its direction with rate increases, not breaking, authorizing us to distribute 3.35 billion of share buyback to our shareholders. That's about 10% of our market cap. Kind of underscored with facts that the situations are very different.
Today, with a couple of notable exceptions in the US, it almost feels like nothing happened last month. Is the storm really over, or might there be more to come?
Well, I do think it's more a question of, and we discussed it recently, notwithstanding what we think about globalization, deglobalization, or reglobalization, I think we are substantially changing the rules that have held for all of our economies and our politics for the last 50 years. And you're having a redefinition of value chain, a redefinition of political weights, a redefinition of friends and foes. Interest rates that for Europe have not been positive for 15 years and now are positive. Energy prices that are changing, structural inflation in the system. It's just not credible that we're not going to have uncertainty, and shock. So I think what has changed is we managed for a central scenario, and at the moment we all feel, okay, we're back to a central scenario. But you need to anticipate that you're going to get deviated by one issue or another. And as long as you are prepared for that and you react quickly, hopefully you're going to be okay.
Bank regulators in the United States and in Switzerland swooped in with backstop funding to keep the crisis contained.
家から会社、会社から家へ。どんな時だって自分の好きなことをしていたい。欲しいもの、聞きたいもの、見たいもの。毎日にどんどん溢れている。
It happened with the Swiss government, Swiss National Bank, it happened with the Fed, the FDIC. We've learned over the past 15 years that government action has unintended consequences. Should we be worried about the unintended consequences of this government action?
Well, I think that when you have a bank of size and confidence goes away, the first thing to go is liquidity. Actually, we all focus on capital. What gets the bank to go is liquidity. These people wanting their cash back now. And so for a government to backstop that and saying that's not going to be an issue is the right thing to do. Can there be consequences? Well, it depends. I think you do that with backstop, but the moment confidence and trust comes back, you need to pull back because otherwise you support all the time and you create asymmetry in the market. But I do think it was what was necessary to be done. I think the more general question for all of us is not only a reminder that banks as organizations that fulfill a role have risks, and you cannot eliminate risks altogether. I read a lot of times, we need to eliminate all the risks for the bank. You cannot. If you eliminate all the risks for the bank, banks do not fulfill the role that they should be fulfilling, and you're transferring those risks somewhere else. And I do think that what we need to ask ourselves is, especially in Europe, what do we want the banking system to do? And then, based on that, what rules and regulations and what guidance do we need to do to run the banks? And I don't think we do enough of that. We do a lot more of what additional rules do we need to do to eliminate the risk, rather than if a bank needs to do X, Y, Z to support the economies, etc., what are the necessary rules and regulation to support that role, but to make it done, to ensure it is done the right way.
Since you've mentioned more than once the importance of trust and the risks of losing liquidity in the system, I want to ask you this. It appears that one of the obvious lessons of the failure, in particular, of Silicon Valley Bank is that today, in our digitized world, deposits can vanish instantaneously. Nobody needs to stand in line, right, to withdraw cash. All it takes is a few clicks on your smartphone. As a bank CEO, do you have to think differently about deposits now?
Well, I think we have been thinking differently about deposited funding for a while. But what I think happens, and especially in Europe, is that the structure of the market is different. When you have this situation, people are reminded that banks are not all the same. That there's strong bank and less strong bank. And therefore you have the flow of deposit, the flow of liquidity towards the quality of the stronger banks, away from the weaker banks. Until you have those shocks, people just pursue convenience and they pursue pricing. The moment you have a shock, you say, well, hang on a second. What I want is preserve capital and have the certainty I'm going to see it back. And therefore there's a flight to quality, and we're seeing it every day. And then it depends with the development of the client base. So depending on where we are between Bulgaria, Romania, Italy, Germany, behaviors of clients and of families and of corporates very different. Some people are still very much attached to branch, to local relationships, and deposits are seen in a very different way to other people who probably are a lot more digitalized. If I look at the use of digital channels in Lombardy and Italy, and I compare it to other regions of Italy, in Lombardy we have 6% of branches and 11% of deposits. I do that same thing in Sicily, and I have a completely different ratio. So I do think it's not one size fits all. And among our market, we just need to follow the consumer or the client and serve them the way they want to be served.
So you're right, of course, that there is a movement of deposits from people, from institutions people perceive to be weaker to institutions that people perceive to be stronger. It's happening here. It's also happening in the United States. That has consequences, doesn't it? I mean, if you lose your funding base and you cannot adjust your assets quickly enough, you've got a problem.
Well, you do, but
again, and regulators are going to have a problem.
You do, but in practice, there's always a question of what is your structure of your asset and liabilities. What is your interest rate risk? For example, at UniCredit, I'm not saying we have a problem, but what I'm saying, at UniCredit, first of all, there are limitations on what we can do with interest rate risk. And secondly, at UniCredit, we swap everything. Everything is floating. So I don't run that mismatch. So that is penalizing the period of low interest rates because I will get the benefit of my interest margin on that mismatch. But by being conservative, when you have a shock like that, I don't feel that for the same kind of conscious. That's why I'm saying rules, and also what is the spirit of regulation, it is the bank running a way that if you get shocked, you can have some risk to take it. And I think you need to step back sometimes because the mere application of rules is not enough.
Andrea, my editor-in-chief, John Mcquaid, has argued that the latest round of bank bailouts signals a new era of what the French would call dirigisme, the state control in finance. And if Europe wants a real banking union, it has to consider cross-border mergers to create continental champions. Is he right?
I think we talk a lot about banking union, we talk a lot about capital market union, and we talk a lot about cross-border M&A. I think the bigger question,
none of those three has happened.
Well, because the bigger question is, and you were saying something about that in your opening remark, is what does the European Union want to be? What does Europe want to be? Because either we want to pursue that convergence that we started with the project, we have a clear ambition to delegate some of our sovereignty of each state to the center and create an economic bloc that can be as strong as the US and China. And I do think that globally there will be a benefit for having a third economic bloc that can stand. And at the same time, for the Western world, it's a very good thing to have. Or we're going to continue to say that we're all different and to say that we have a European Union, but with so many exceptions and so many limitations. And then when you ask me, banking union, I'm sorry, if we're all fragmented, union of what? Capital market union. If we're fragmented, capital market union of what? Cross-border M&A. If I don't have free flowing of capital, liquidity, clients, because I don't have a real united market, what are the synergies and the benefit to the cross-border acquisition? So I do think that the key question is, do we want to, post-Brexit, post-this shock, review what Europe should be and converge to that? Then the banking union and all the objections that we have will go away because we're converging to that. Or we want to remain as we are, saying we are a federation, but not being one, and then say, oh, but I want the banking union as well. It's not going to work.
So just let's get this straight. You are asking what to me sounds like a rhetorical question. If Europe really wants to be on equal footing with the US and the North American market and China and its sphere of influence, it can't just be a monetary union. It has to be a fiscal union. It has to be a banking union. A capital markets union.
It definitely has to go a lot further. I think if you look at European population, education, innovation, GDP potential, it has all the ingredients to be on par or in the middle with those economic growth. We never are. In a way, and in a very small way, it's a macrocosm of what UniCredit is. 13 bank, 13 market, large fragmentation, large complexity. You either bring it to common denominator, or all you have is fragmentation and complexity.
So what role does UniCredit play? Do you become a consolidator in this unified market they say of?
My predecessor believed in a united Europe and built UniCredit. With the benefit of hindsight, if you ask the user channels, they will tell you it doesn't work because it's complex and fragmented. So in our mission statement, we want to be the bank for Europe because we are highly dependent on Europe. We want to say winning Europe because that would create an immense opportunity for UniCredit. But UniCredit cannot become a pan-European bank if the European Union is fragmented. It will not, and no other bank can do that.
So in other words, are you telling me that you're not going to go out and buy anything in any of the countries in which you currently have a footprint? in Germany, in Italy, or any of the other countries in Europe in which you don't have a footprint until there is movement on this banking union?
What I'm saying is that at the moment, the incentives to do M&A are limited to countries where you're local. We're local in 13 countries. Other banks are local in 2 or 3. Other banks are local in 1. Once you cross the border, if you do not have a unified market and free-flowing capital, free-flowing utility, and common rules, your synergies block. And therefore, there is very limited incentive to pursue that.
I know people here have a few questions about the economy, as they should. Bank balance sheets are supposed to be one of the chief transmission mechanisms for monetary policy. Here in Europe, as you've alluded, the ECB is still trying mightily to slow inflation. Are we going to tighten access to credit?
Well, I think that you go back to what is the broader picture. You go back to what should bank be doing. So, if banks are a transmission mechanism, and they are, and if capital markets are underdeveloped in Europe, as they are, whatever monetary policy you want to have or economic policy, you need to use the banks. So, if you provide liquidity that restricts the banks from multiplying it, then you're working against yourself. At the moment, regulation and objectives are not. They're not aligned. So, because the regulation is to make banks strong, not take risk, etc. But when you have a recession, what are you doing? When you have COVID, what are you doing? You're flexing. And so if you flex and it restricts on the other side, you have two opposing objectives. As far as we're concerned, we are very well capitalized, we're very liquid, and we see this disruption, or this uncertainty of that disruption, as an opportunity to bring to bear our strengths. So we're not restricted. We're disciplined. We know where we want to expand, where we don't want to expand. We look very, very closely at risks. But at the moment, our stance is one of steady as she goes and probably trying to gain share, not losing.
And what about credit quality? What about the quality of your loan book?
Well, this is one that is a very interesting question because I think everybody in the room will look at what's happening with inflation, what's happening with energy prices, what's happening with the P&L of corporation or the budgets of families below a certain level, and you would say your credit quality is going to go really bad. But we started saying that since the invasion of Ukraine, and every quarter the banking system has registered record low cost of risk. So it does seem that the transmission is not happening. My view is that the economy is very different from what it was before, in as much as government intervenes in certain sector, intervenes in certain segments of the population with subsidies and with incentive, and it's fragmenting the way the economy is reacting. That said, our base case is that the cost of risk that we have this year will remain at the same level as we had it last year. And that's the scenario that we have. We have, as of April, no indication of a worsening of our cost of risk, not in corporate, not in retail. And however, because we're not sure we're right, we have 1.8 billion of overlays in case things are go the wrong way. So it's almost like we're managing from a central scenario, and we're looking at what we see, but our mind is telling us that maybe we're missing the iceberg. And if we are, we have something to protect us.
Andrea, you told us earlier that the future you see is one of uncertainty. What kinds of crises should we be preparing for?
I think one of the key things that I probably learned in my days of investment banking is that the next crisis is never the same as the prior one, because everybody's very focused. Now we're all focused on liquidity.
That's in the rearview mirror.
Okay, how much have we been focused on liquidity in the last 10 years? No. Interest rate risk, how much have we been focused on interest rate risk in the last 10 years? Okay, so now it's shocked. Now we're very well aware. And now the question is, what else? Is it climate change? Is it disruption of value chain? I mean, we underestimate the effort that certain companies, you take an automotive company. Somebody was telling me that if you are building an internal combustion engine in Germany, your dependence from Russia used to be de minimis. On an electric car, more than 50% of that parts. So that does not mean, what does that mean? That means that we need to reallocate the entire value chain away from the provider somewhere else. And by definition, it's going to be more expensive, and the speed of obtaining the parts and what we need is going to take longer. That means that entire sectors are redefining the logistics, the providers, their cost of production, and all of that is happening in a compressed timetable where you have uncertainty in the economy and therefore you're asking yourself, am I investing too much because the world is growing only at 1% or 2%? Conversation there between Unicredit Group CEO Andrea Bocelli speaking to Eric Chester at the Bloomberg New Economy Gateway Europe in really fascinating lines on the cost of risk, really interesting on the fallout, of course, of the banking crisis and the changes more broadly, the fundamental changes that are happening in this economy. Saying that we're constantly not concerning in terms of contagion, pretty worried about the contagion at the beginning of the crisis in terms of lack of confidence, but now they are thinking differently. He said about deposits and funding, and saying that in terms of M&A, and that's a big question, of course, European banking space consolidation. In terms of M&A, that the incentives for cross-border M&A are pretty limited. Coming up, we are going to be sticking to Bloomberg's New Economy Gateway in Ireland. We're going to speak with my Answers Director, General Willie Watts. Really interesting conversation coming up then about travel and the pickup that we're seeing that can be sustained as airlines get back onto a slightly surer footing. That is coming up. This is Bloomberg.
もう聞いた？お笑いのポッドキャストあるんだね。あ、本当だ。この人のトーク、マジ面白い。
Welcome back now. Bloomberg New Economy is hosting its inaugural event in Europe, which will bring together regional leaders to discuss the most pressing issues facing its economies. Let's cross over then to Ireland, where Francine is standing by with a guest. Francine.
Thank you so much, Tom. I'm delighted not to talk aviation. We were just talking before about healthcare with AstraZeneca. Then we heard from Andrea Bocelli, and now we're delighted also to be talking about aviation with the IATA chief executive Walsh. Thank you for joining us. I mean, jet fuel, inflation, there's so many concerns out there. How are you expecting that to impact the aviation industry in the next 12 months?
Well, I think positive is demand remains strong. And so when we look at high oil prices, we've seen that before in the industry. Inflation, we've seen that before. If you've been around long enough, these are business as usual challenges. And it's clearly a much better environment than it was for the past few years.
But then talk about possible recession. And we haven't really, there's a mismatch between what chief executive companies expecting worse to the real base of the economy. How we expecting, I guess, the recession and what that means for consumer demand on China?
I think most talk of recession, as they used to indicate, certainly about 3 months ago, I think there was a lot stronger concerns about recession. The interesting thing we are seeing though is employment levels remain quite high, and therefore I think people still have confidence in spending. So it's quite different to situations we've seen in the past, where typically these concerns about recession are also associated with higher and increasing levels of unemployment. So it's a different scenario today. And all of the CEOs I'm talking to the industry remain cautiously optimistic about the outlook for this year.
But it's already think the recession will be shallow, or because it's still expected demand because we're not definitely
Yeah, clearly demand remains strong, but I think there's also another factor from the airline point of view. That capacity is rapidly not as massive as people had expected, and some of that is because of disruption to supply chains. A lot of airlines have difficulty getting spare parts, because delays in the delivery. And so we're seeing quite a good match between the increase in demand and the increase in capacity.
how will they run these supply chains? How long is it?
Yeah, I think it is a concern, particularly in relation to spare parts. So pretty much every airline CEO I've talked to now is expressing concern, and there doesn't appear to be any near-term fix. So this will probably continue into 2024 and maybe beyond. But we would expect the manufacturers to face issues.
This is about
And the existing regulatories that were in operation that were grounded in 2019 are not coming back into service as fast as people expected, because the parts are currently getting back into work.
China reopening air travel.
Yeah, that's positive, because we didn't expect China to open in January. So if I look at international travel within Asia, last year it was at 22% of where it was in 2019. In February we were at 57%. So we're seeing capacity and demand coming back in Asia. It's a bit slower than maybe people had expected. And I think that's because people remain a little bit cautious, and some countries still have some travel restrictions in place. So it's a positive, definitely, but I expect European airlines to be a bit more cautious about adding capacity to China than the Chinese carriers into Europe.
Are the Canadians have to do more, a lot more when it comes to climate change? Or actually, given also the situation with fuel because of Ukraine, that seems to take a little bit of time.
Well, I think the positive is that even through the recession, airlines continue to invest in sustainable fuel and make commitments to further future purchase of sustainable fuel. And despite the crisis, every single drop of sustainable fuel was supported by the airline industry in 2021, 2022, and again this year. So we're absolutely determined. We made a commitment to net zero in 2050. We know what it is we have to do. What we're looking for is some government policies to support the production of sustainable fuel. Because there's no issue with demand. I've heard some people say that they need to see demand signals before they build the capacity. The demand is there. It's real. Everyone's going to buy it. We just want to see it in better quantities.
We watched this doing this. That was the chief executive officer of IATA. With that, Tom, I'm going to send it back to you, and then we'll have plenty more throughout the day here.
Okay, great stuff. We're going to of course, on the ground at that event. Coming up, UK inflation coming in hotter than expected. We discuss what this means for the bank rate. As next, this is Britain. Economics, finance, politics. This is Bloomberg's Finance Edition. I'm Tom McKenzie in London. Now, to one of the top stories of the day. UK inflation has come in hotter than expected. 10.1%. A reminder that the UK is now the outlier. 6.9% in the Eurozone. We're going to get refreshed data just in the next couple of minutes. Europe, 5% in the US, 10.1% in the UK. That's pretty interesting. Managing editor for Bloomberg Markets today. And Christine, there has been a market reaction to this data.
Absolutely, Tom. It wasn't entirely clear. If you look at the pound chart, there was a really clear spike initially after the inflation print, and then I think traders were realizing that, oh no, more BOE rate hikes, potentially bad for consumers in the long run, and so we saw a dip in the pound. Eventually, it ended back up again. So I think traders are just trying to make sense of the immediate impact. I mean, it is positive in short term, but in the long term, they're questioning what this all means. If the BOE ends up doing more rate hikes than they expected, what is that going to mean for consumer debt, household mortgages, and things like that in the long run?
And gilts selling off. You're seeing that quite pronounced at the front end. A 13 basis point move higher in years 382 at the front end. Gilt 2 years. What does it mean for the BOE? What are the markets then in terms of pricing in May, June, and beyond for the Bank of England?
Well, I think they're definitely nailing on those expectations for rate hikes, definitely for May as well as June, as far as the markets are concerned. And the Bank of England, I think, is going to have to follow suit, just because in a combination of today's data as well as yesterday's unexpected wage increases really just drives home the point that inflation in the UK is proving particularly sticky, especially compared to the Eurozone and the US. Both of those are single digits, heading in the right direction. That's really just not the case for the UK.
Different story. Political costs agree as well for the Prime Minister as he continues that pressure on halving inflation at the end of the year. So if that indeed comes to the fore, always excellent, of course, breaking down the market reaction to that CPI breakdown in the UK. Christine Aquino, we're also minutes away, as I mentioned, from the March inflation print for the Euro area. That after ECB Chief Economist Philip Lake told us he is backing a rate hike at the next meeting. European markets down 0.3%. Futures in the US down by 4.6% on the Nasdaq futures. Bloomberg's Finance early edition continues. In the next hour, we're back in New York and Edwards here in London. This is Bloomberg.
I think there's going to be more volatility in the years, and I suspect on average it'll be
Inflation is going to go back to the recession. The economy is not going to go into recession.
If inflation targets remain as they are, and we do have central banks pushing to try and get inflation back down to target, well, there is this risk to the economy, there is this risk of something else breaking.
This is Bloomberg Surveillance Early Edition with Ella Edwards and Matt Miller.
あのベージブルガリアヨーグルトからアイスが届きました。
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Job cuts are on the way at Meta and Disney. Thousands of positions are being eliminated starting today. New figures strengthened the case for the Bank of England to raise interest rates once again. Its inflation rate remained in double digits last month. And now as Morgan Stanley stack up against its Wall Street peers, the bank reports its earnings in 2.5 hours' time. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London, with Matt Miller in New York. Inflation story certainly dominant here in Europe today, Matt. Over in the United States, banks and futures slip a little, so negative sentiment about its earnings.
Yeah, well, and I feel like the UK inflation story is actually reverberating around the world, because a lot of people are now expecting tighter rates or higher rates for longer. We had comments from Bullard yesterday saying he wants to go between 5.5 and 5.75. And he's not a voting member, but he makes some very strong points. Let's take a look at what's going on in the U.S. markets. We are now down about 4 tenths, almost 0.5% on S&P futures. We managed to eke out a gain in the cash trade yesterday, but the Dow and the Nasdaq both closed
closed down. So the S&P was kind of the outlier there. We have bonds down as well, and that pushes the yield up another 4 basis points. Wow, 420. We're almost there, by the way. Right now, 361.76 is the level on the 10-year, but you see yields going up much higher on the 2-year on the shorter end of the curve, as well as investors maybe starting to price in more than one rate hike. NYMEX crude is off about 2% right now. We're down below $80 a barrel. We've fallen below key levels on a lot of big commodities. Bitcoin is down about $1,000 under 30 right now. NYMEX under the $80 handle. Gold down under $2,000 right now. Right now it's off 1.3%. It fell a little yesterday as well. So gold is now under $2,000, and we see just a lot of selling in these markets. Take a look at what's going on in Asia. You saw a drop there as well on the MSCI Asia Pacific Index down 0.8%. The Hang Seng down 1.3, 1.4%, and it closed. It had been lower, so it was able to offset some of those losses into the end of the session. The Nikkei in Japan off at only about 0.2%. We do see dollar weakness, not against the pound. I think the pound is still up against the greenback, but we see dollar weakness against other currencies like the euro and a little bit of dollar strength against the yen right now. 134.86 is the amount of yen. You can almost buy 135 yen for $1. What do you see in Europe this morning?
Yeah, the inflation story certainly dominates then that we've just got Eurozone inflation, the final reading for the month of March. This didn't tell us anything we didn't know. They said, in fact, they're not getting exactly as expected. So Euro area final March reading on inflation, CPI rising by 6.9%. That was exactly what we said. So as you were on that front, but that's still a lot lower than it was. It is a lot lower than the UK inflation. European markets, the London market sells off a little bit more than the others. It's the euro got much movement as a result of that inflation data, as I said, came in pretty much as was expected. We did see a boost to the pound. In fact, the pound is trying to understand exactly what it meant to see that inflation rate once again come in above 10%. So double-digit inflation is still a reality in the UK. It has been expected to drop down below 10% in the last two monthly readings, and that has not happened. So the pound spiked up on that on the BOE impulse, but then dropped and then spiked up again. So a lot of volatility there. UK 2-year yield taking no time to decide what to do. Pricing with more certainty and may increase interest rate hike from the Bank of England. So that's the bond market's going to decide what this means, and also pushing out that peak rate, or increasing, that peak rate where markets think the BOE will get to. Here are a couple of those stories to focus on with different dynamics actually. Heineken, the drinks maker. Interesting that the volume numbers were locked versus expectations, but because European drinkers seem to be happy to continue paying up for those drinks, the investor community sees something positive in that and stock up by more than 3% as Europeans turn to drink that. ASML down by 2.5% as we have the company that supplies the companies that make the chips. There have been a lot of negative expectation at the beginning of this week around what demand out of Taiwan in particular, but look like some of that is stickier despite the earnings story put out today. The outlook for the second half of the year a little hazy, so as a result, the stock is down.
Europeans are turning to drink. It's in their DNA. They're just turning it up a little, I guess. All right, I think the ASML story is fascinating. We're going to be watching that, as well as the chip news that we've gotten from other behemoths like TSMC cutting capex. It doesn't look good for the global economy. Neither do the job cuts that we've been seeing overnight. Disney plans to cut thousands of jobs next week. That's what Bloomberg's learned. That includes about 15% of the staff in its entertainment division. This is a company with 220,000 employees. Meanwhile, Facebook owner Meta is set to begin company-wide layoffs today. A memo seen by Bloomberg indicates that Facebook, WhatsApp, and Instagram, as well as Meta's virtual reality lab, will all be impacted. Bloomberg's Alex Webb joins us now for more. So, as we've seen, on the tech side, on the West Coast, we've seen some of these job cuts, but they're now starting to really ramp up and going into other areas like entertainment, communication services, media streaming.
Yeah, it's very much kind of reckoning for these companies that have absolutely been classified as growth stocks for a few years. Disney pivoted from value to growth under pressure from activist investors. It's now retrenching. It is laying people off from its entertainment division. The push has largely been towards Disney Plus. As we've seen interest rates come up, we've seen people not spending as much time in front of their devices as they come out of the lockdowns, and that has hurt wickets like Disney Plus. Meta reports on the fascinating with their job cuts, according to sources. The memo seen by colleagues Bloomberg News, they are cutting the Reality Labs division. That is their metaverse effort. That's supposed to be the future of the company. It's a division of Facebook, that Meta has really ceased to talk about with quite so much volume as it was, even a year ago. So we are seeing something of a retrenchment of things.
Okay, focus on cost cutting then in terms of those tech names. What about the Netflix earnings story then overnight, Alex? The earnings and then the crackdown on password sharing.
There were three numbers that were really important here. The first quarter, subscriber growth wasn't as high as expected, 1.75 million versus 2.4 million expected by the market. The second quarter revenue was also short of expectations. That took the stock down about 12% in after-hours trading. But then as people started to look a little more deeply at the numbers, the expectations for the second half were quite good. Free cash flow, 3.5 billion, that was above expectations, above the company's forecast of 3 billion. They increased that forecast. Part of that is to do with cracking down on passwords. It didn't happen in the first quarter, but what they're doing is they think there are 100 million people out there sharing passwords. If they can get some of those to subscribe, then that will benefit subscribers.
Yeah, interesting that they're trying some of those strategies for that crackdown in Southern America. Thanks very much for that. So we're back to the latest tech themes. Let's pivot to the macro. And UK inflation has come in hotter than expected. The March CPI reading rising 10.1% year-on-year. Economists had expected that number to drop into single digits to 9.8%. This comes after Tuesday's report showing UK wage growth accelerated unexpectedly last month, adding to inflationary pressures concerning the Bank of England. Joining us now to discuss this, managing against the big markets today. Christine, very good to have you with us. So we've got this combination of faster inflation, more rate hikes. Is that what is ahead? More rate hikes for the Bank of England?
I think that's definitely the conclusion from markets, and I think we see from pound reaction as well as the gilt losses today. Most signs in markets are pointing to that expectation that the Bank of England is going to have to do more, and it's probably not something that Andrew Bailey and his colleagues really want to hear because they were guiding markets toward expecting less, even from the start of this year, and even the most recent comments from them, despite the fact that we have double-digit inflation still persisting. But I think after today's data as well as yesterday's wage data, most signs really are pointing to the Bank of England having to act to those rate cuts.
So are people worried about a policy mistake here from the Bank of England as they are, in the U.S., and how are traders expected to react?
Well, yeah, definitely thinking about the potential mistakes here. I think initially, given that the guidance from the Bank of England was for markets to expect less in the way of rate hikes, but we just kept getting persistently high inflation readings. It hasn't dipped down to single digits for a few months now. And I think that's where potentially the initial mistake was, right? That the initial guidance for less in the way of rate hikes and now having to potentially backtrack on that given the inflation inflation prints. But I think toward the back half of this year, the potential mistake could probably come from expectations of the Bank of England having to pull back on their efforts because of the impact of the rate hikes. It's a very similar dynamic to what we've seen in terms of how markets are trying to read the Fed, right? They're kind of trying to think, well, the rate hikes are going to be negative for the economy eventually, and therefore expect rate cuts. But just given the persistence of inflation in the UK, it's going to be hard to see a situation where that would be viable even in the second half of this year.
All right, Christine, thanks very much. Christine Aquino there talking to us about 10.1% inflation, beating the estimates on kind of the wrong side yet again. Let's get back here to the U.S. Legendary trader Lee Ainsley of Maverick Capital sees inflation increasing once the war in Ukraine winds down. He spoke at the Economic Club of New York yesterday in a rare appearance.
通信安定しない月々の回線料金知らないこの中で一つでも当てはまったあなたそれ通信の見直しタイミングうちの光回線にはユーロ光1年間の月々の基本料金は980円しかも下り最大 2Gbps さらに日本顧客満足度ナンバーワンユーロ光今すぐホームページをチェック
ジャケパンスタイルに挑戦したいでも高そうパブリック東京ならなんとこの価格からオーダーメイドのジャケットが作れますオーダーは簡単店舗へ行って採寸してもらうだけ一人一人の体型好みに合わせて最適なサイズをご提案店舗で一度採寸サイズ登録すればその後は
My thinking is that the baseline inflation underneath all this is actually continuing to march upwards. Decarbonization, deglobalization, people miss just the aging of our population, the active workforce is shrinking. That's part of wage inflation. And so do you think particularly wage inflation may be a little stickier?
Shonali Bassett, our global finance correspondent, joins us now in studio. So, Shonali, we heard it from Ainsley there, concerns that this inflation is going to be persistent.
They definitely have one of the most well-known tire cuts now, beating that higher for longer, John, something you heard from Jim Dimon just about a week ago. And listen, there were some very interesting implications for the hedge fund industry in particular. Some of the things he pointed out was what this would mean for the pod model. Remember, a lot of these multi-strat funds run on a lot of leverage. And so what does it mean as interest rates go up, not only for their own models, but competition for money? The other thing he talked about, Matt, is what it means for the crossover fund model. A lot of these hedge fund firms have gone into the private equity business, which also requires significant leverage. And, it's an interesting equation when you think about the capital calls they also need to keep making to try to meet those new investments. So remember, David Solomon, yesterday over at Goldman Sachs, got a question from an analyst about the worries about the hedge fund industry. His answer really was that Goldman in particular is flocking to the top 100 funds. And so you do see a washout in the industry that's already been at bay, but have banks react to the industry and the leverage they're willing to provide them, the business they're willing to provide them, will really set the stage for the investing world in the next year or so.
And we've seen how quickly that can go unstuck in the past, haven't we? Let's get to the pandemic story. Morgan Stanley set to report numbers. What do we expect to see then here, Julie?
Yeah, one is on the trading side here, again, because Morgan Stanley is one of the biggest brokerages on Wall Street, has historically been the largest equities trading shop on Wall Street. While we watched Goldman miss on fixed income yesterday, they beat on equities trading. So it is a soft market for equities trading, but Morgan Stanley still holds strong in that market after last year kind of falling behind Goldman for a couple of quarters. The other thing we'll want to watch is what they have gained in terms of business in the wake of Silicon Valley Bank's troubles. Remember, Morgan Stanley would arguably want to be one of the biggest beneficiaries here, Anna, because Morgan Stanley has such a big base of high net worth clients. We have seen, there's no other way to put it, the biggest banks really benefit in the wake of this storm. Things are looking like they're starting to stabilize, as we saw from Western Alliance's own numbers yesterday. But how much has Morgan Stanley won, and how sticky will some of that business be?
All right, our top Wall Street reporter, Shonali Bassett, thank you so much for joining us this morning. Now let's get a look at some of the stocks we're watching in pre-market trading here in the U.S. this morning. Keeping an eye on regional banks. Western Alliance has surged as deposits rise by $2 billion. You can see the stock there up 15%.
My thinking is that the baseline inflation underneath all this is actually continuing to march upwards. Decarbonization, deglobalization, people miss just the aging of our populations, or the active workforce is shrinking. That's part of wage inflation. So do you think particularly wage inflation may be a little stickier?
Shonali Bassinger, global finance correspondent, joins us now in studio. So, Shonali, we heard it from Ainsley there, concerns that this inflation is going to be persistent.
Yeah, you definitely have one of the most well-known tiger cubs now beating that higher for longer drum, something we heard from Jamie Dimon just about a week ago. And listen, there are some very interesting implications for the hedge fund industry in particular. Some of the things he pointed out was what this would mean for the pod model. Remember, a lot of these multi-strat funds run on a lot of leverage. And so what does it mean as interest rates go up not only for their own models, but the competition for money? The other thing he talked about, Matt, is what it means for the crossover fund model. A lot of these hedge fund firms have gone into the private equity business, which also requires significant leverage. And, it's an interesting equation when you think about the capital calls they also need to keep making to try to meet those new investments. So remember, David Solomon, yesterday over at Goldman Sachs, got a question from an analyst about the worries about the hedge fund industry. His answer really was that Goldman in particular is flocking to the top 100 funds. And so you do see a lot of the industry that's already been MA, but have banks react to the industry and the leverage they're willing to provide them, the business they're willing to provide them, will really set the stage for the investing world for the next year or so.
We've seen how quickly that can come unstuck in the past, haven't we? Let's get to the bank earnings story. Morgan Stanley set to report numbers. What do we expect to see here tonight?
Yeah, what's on the trading side here? Again, because Morgan Stanley is one of the biggest prime brokerages on Wall Street, has historically been the largest equities trading shop on Wall Street. While we watched Goldman miss on fixed income yesterday, they beat on equities trading. So it is a soft market for equities trading, but will Morgan Stanley still hold strong in that market after last year kind of falling behind Goldman for a couple of quarters? The other thing we'll want to watch is what they have gained in terms of business in the wake of Silicon Valley Bank's troubles. Remember, Morgan Stanley would arguably want to be one of the biggest beneficiaries here, Anna, because Morgan Stanley has such a big base of high net worth clients. We have seen, there's no other way to put it, the biggest banks really benefit in the wake of this storm. Things are looking like they're starting to stabilize, as we saw from Western Alliance's own numbers yesterday. But how much has Morgan Stanley won, and how sticky will some of that business be?
All right, our top Wall Street reporter, Shonali Bassinger, thank you so much for joining us this morning. Now let's get a look at some of the stocks we're watching in pre-market trading here in the U.S. this morning. Keeping an eye on regional banks because Western Alliance has surged as deposits rise by $2 billion this month. You can see the stock there up 15% in the pre-market. PacWest up 4 1/3% in sympathy. So watch those regional banks in this morning's trade. Intuitive Surgical reported worldwide procedure growth for the first quarter that beat analyst estimates. You can see the stock up 7% in the pre-market. Procedure growth worldwide, so surgeries that it's done, was 26% higher than it was at the same time last year. The estimate was only for 15% more procedures. HP and Dell are among some of the technology companies that are falling in the post-market trade. You can see HP here down 2% in the pre-market. Sorry, the pre-market trade. They were down in the post-market yesterday as well. IT products and services company CDW reported preliminary quarterly results that missed. And then Tesla cutting the price of its highest volume models yet again in a further sign that the chief executive officer Elon Musk is willing to sacrifice some of the industry-beating profit margins that Tesla has in order to build even more demand. The Austin-based automaker marked down some more Model Ys and Model 3s, an average of about 5%. And I think they cut prices now like 5 to 6 times so far this year. So a lot of consumers are maybe waiting to make a purchase for that next price cut.
And we will get some analysis of what to expect from Tesla in the earnings story there shortly. We've also got European car sales numbers showing some robustness as we say goodbye to some of those supply chain issues post-pandemic. And now, just to tell you what's coming up on the programme, we will be speaking to Fishka Maharaj, multi-asset strategist at JP Morgan Asset Management. How is she playing the current environment in markets? What do you make of the latest inflationary drivers that we're seeing here in the UK and perhaps elsewhere as well? And Carol Pickering joins us, Berenberg senior economist, also to weigh in on the inflation story. Thanks, Fishka.
Q1 suggests we are seeing a reversal of the negative supply shocks that was so dominated the European economy last year. So easing of bottlenecks, much lower gas prices. So what I would say from all of that is, as of now, 2 weeks away, I think the baseline is that we should indeed increase interest rates in May.
As the ECB chief economist Philip Lane speaking at the Bloomberg New Economy Gateway Europe Conference in Wicklow in Ireland, Bloomberg TV and radio are broadcasting live from the conference. We've heard from a number of leaders from the private and public sectors today. Tomorrow we'll hear from Ireland's Prime Minister, Leo Varadkar, among other voices. Joining us now here on set to talk about global strategy, Fishka Maharaj, multi-asset strategist at JP Morgan Asset Management. Fishka, very good to see you. Philip Lane talking about the inflation story, but I'll start with the impact of the inflation story here in the UK. How does this influence your thinking around asset allocation on UK assets, given inflation still double digit, food inflation running at not quite 20%, but high teens?
Yeah, thanks for having me, Anna. You're right. Inflation, we've had a very timely reminder that the inflation, stubborn and persistent inflation is here to stay for longer. I'd say the UK is a particular example where you have twin shocks that you are dealing with, both the labour force participation being weak and the energy shock. And for us, that complicates the Bank of England picture. What does that mean for our views on UK assets? We are warming up to duration, so core gilt bonds, but today's data does add some volatility to that. The reason why we are looking at the gilt market as a positive market to own duration in is essentially the market is pricing in over 50 basis points of hikes from the Bank of England. We want to diversify duration across markets. On the equity side, we actually are more positive on UK equities, but that's because of global factors rather than specific UK ones.
Right, yes, as is also the case with UK equity conversations. It's a global story, perhaps, at least at the 5100 level. What about more generally then, your outlook and your positioning? You said in your notes ahead of our conversation that's pretty cautious. What does cautious look like?
Cautious means we are modestly underweight risk assets, so modestly underweight in equity markets. And the rationale for that is unlikely to see significant upside for risk markets in the current environment. As you mentioned, inflation remains a concern that keeps central banks in their tightening path. We have already had a reminder in March that policy is already tight, and we will see credit conditions tighten further, and that caps the growth outlook in the medium term. So essentially, this idea that equity markets have run a long way, the upside is capped, that keeps us cautious. But at the same time, the caution we are expressing today is actually in being long duration. We see more asymmetry on the bond outlook, better return profile there than we do in equities.
Okay, Matt.
Yeah, it's interesting, Tushka, because we have seen bond spreads tighten and the VIX drop to below 17. At the same time, I'm hearing the term credit crunch more and more often. You said we could see credit conditions tighten. How much? And could it be to a concerning level? Because it looks like relative calm in markets, both in bonds and in stocks.
Yeah, that's a valid point, Matt. And I think you're honing in on the exact question we're facing ourselves. Is this going to be a sharp, quick drawdown in growth expectations, or is it a slow burn grind lower in the economic outlook over the next 6 to 12 months? And I'd say credit availability, loan growth, and the labor market are key in sort of answering that question. So firstly, on the credit side, we are expecting slowing of credit availability. That, of course, takes off maybe 2/10 or 3/10 on GDP over the next 6 to 12 months. But we're not seeing it creating this cratering crunch in credit conditions. So we are more in the camp that this is a slower grind lower in the growth outlook, and it will take time to play out. And as you mentioned, there are two-way risks around this. We're already seeing deposit inflows, as you mentioned earlier, coming back to some of the regional banks in the US. So it's more of a slower grind, and we're looking for opportunities for where we can be cautious, but be willing to wait this out as growth slows.
Yeah, I mean, a lot of people are looking at the banking crisis in our rearview mirror now. We're seeing Jess Menton from our equities team, as well as Cameron Kreis, our macro man columnist, saying, look, expectations of a recession were much bigger at the end of last year and at the beginning of this year than they are now. Jim Bullard, obviously you're not going to have the Fed come out and push for a recession, but he's saying, I don't see it here, especially with the labor market that we've got. Are expectations of a recession now lower than they were previously, meaning risk assets have a chance to continue this run higher?
Yeah, so we have increased our recession risk post the banking stress in March, but it's not our base case. We're not in the camp that we're like that the recession's nailed on and that we need to be extremely cautious. What's keeping us cautious is that even in our relatively positive view of the economy, we think risk markets have already run a long way, and in a positive scenario, central banks are still hiking, so they are raising the cost of financing as growth improves, and that caps the upside for risk markets. But what you highlight is a valid point. Where can we look for that asymmetry? And credit or high quality components of credit are starting to look attractive in our base case scenario. Recession risk for us, I'd say, is a bit, is between a 25 and 30% likelihood over the next 12 months in the US. But look outside the US, growth in Europe, China, we are seeing a much better outlook there. So it's very differentiated across the globe.
All right, Dushka, great to have you on the program. Really appreciate your insight. Dushka Maharaj of JP Morgan Asset Management talking to us about really the importance of active. You got to pick your spots for that opportunity. Now, keeping you up to date with news around the world, here's your first word. Senior Russian officials have raised concerns that the war in Ukraine has left Moscow too reliant on Chinese technology after the U.S. and EU sanctions shut off access to alternative suppliers. An internal Russian memo suggests Moscow is cornered and concerned that Chinese technology reliance may pose a risk to Russia's information security. Fox News has avoided a potentially embarrassing trial. The network agreed to settle with Dominion. They'll pay $787.5 million to settle that voting machine maker's defamation lawsuit over its 2020 election broadcast. This is Bloomberg.
質問来たブログを今から始めるのは遅いですが、結論から言うと今からでも間に合います。全然も
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Job cuts on the way at Meta and Disney. Thousands of positions are being eliminated starting from today. New figures strengthen the case for the Bank of England to raise interest rates again. Britain's inflation rate remains in double digits last month. And how does Morgan Stanley stack up against its Wall Street peers? The bank reports its earnings in 2 hours' time. I'm Anna Edwards in London with Matt Miller in New York. And sentiment deteriorating the closer we get to the start of US trading. We're seeing the inflation story out of the UK, certainly catching our attention from the macro standpoint, but a lot of corporate earnings to focus on as well.
Yeah, I think we had Goldman Sachs and Johnson & Johnson yesterday dragging on the indexes, and now you've got this big inflation number out of the UK, I think igniting a little bit more concern around the world that that inflation could be higher for longer and rates may have to go higher with it. We heard from Boston, we heard from Bullard, and we'll talk about that in just a little bit. S&P futures are down about 0.5%, a little bit more now than 0.5%. You're seeing a lot of selling in this market no matter where you look. For example, investors are selling off the 10-year note, and so the yield rises another 4 basis points right now, 361.57. 9x we were at an 80 handle or above, really. We got up to $83 a barrel post OPEC plus surprise cut. Now we're coming back down below $80, and even Brent is looking pretty weak. Gold had been up above 2,000. We were on all-time record watch to see if it could eclipse 2,075. It's now back
down below that, not terribly significant, but big round number of $2,000 a troy ounce. And even Bitcoin, for example, is down about $1,000 below 30,000 right now. So investors are really taking some chips off the table. Take a look at some of the movers here in terms of individual stock stories. You have some good news. Western Alliance rising after the bank beat earnings estimates and said deposits recovered. You can see Western Alliance is up, and then other regional banks are gaining in sympathy, but 15% is better than a stick in the eye. Intuitive Surgical, also a big gainer, 7% this morning, saying that worldwide procedure growth for the first quarter beat the average analyst estimate. They did about 26% more procedures than they did in the same quarter last year, and the estimate was only for 15%. Netflix, on the other hand, is down 1.5%. We talked to Alex Webb about this just about 15 minutes ago. Netflix is down as investors are weighing customer additions and the firm's outlook. First quarter new subscribers came in at 1.75 million, and that missed some forecasts. It missed some. Netflix will start to crack down more on password sharing in the U.S. this quarter. Predicts that will boost growth in the second half because people who have been thus far, I guess, stealing Netflix are going to have to actually pay for it. And then Tesla cutting its prices again on some Model Ys and Model 3s. These are the more affordable models that Tesla has in the lineup. And another sign that Elon Musk is willing to sacrifice some of his industry-beating profit margins. They have profit margins that big automakers would do a heck of a lot for, like 14, 15% rather than 7 or 8%. So they can afford to sacrifice that to get more sales. But the question is, if they continue to cut prices, Anna, do you go out and buy a Tesla, or do you wait for the next price cut that you expect? That's the problem with deflation, right?
Yeah, absolutely. And there's a lot of thinking around how customers behave with expectations around inflation very much in their minds at the moment, because we talk about it all the time. Let's get to the European equity market picture then. Stocks Euro 600 down by 0.4%. And inflation is one of those things that we're very much focused on today than that. In the European context, broadly, we had Eurozone inflation data confirmed at 6.9%. Higher, of course, the ECB wants to see it later in that exclusive conversation with him at the ECB, saying that he thinks we need to see another interest rate hike. But the expectation in the market is we see a lot more hikes, really, from the ECB, certainly versus the Fed. The Euro, though, not moved by that particularly. 109.32, it was an inline inflation number. And the 2-year yield, though, certainly moved by what we've heard here in the UK. 12 basis point move on 2-year yields, increasingly expecting in the markets that we will get another hike from the Bank of England then in the month of May. The expectation around that seems to have firmed up because that inflation print came in the UK at 10.1%, above 10% essentially, and not dropping down into single digits as have been the expectations. Are really sticky there. Food prices, we haven't seen food prices like this, man, since you and I were very small, put it that way. Food price growth like this, I should say. ASML is down by 2.7% on the earnings story. Just covering off that one here in Europe. It's not about the backward-looking sales, they were okay. It's about the forward orders, and that seems to be weighing on the stock today.
I remember when I was a kid, I could buy a candy bar for like $0.25. It'd be great to see food prices like that again. But yeah, I get what you mean. This kind of inflation is just shocking. And I think that the UK numbers are concerning even here in the US as well. Joining us now is Callum Pickering, Berenberg senior economist, to talk about this, the second time in a row that we've had expectations for UK inflation to fall below 10%, and yet it holds fast. What's going on? And is that kind of stickiness in prices going to be felt in Europe and in the US as well, Callum?
I think we just need to be a little bit careful putting too much weight on upside surprises when we have fundamentals pointing towards disinflation. And so, of course, we have to be cautious. The Bank of England will be, relative to its February estimate, surprised by what Q1 inflation has done. No question. And therefore, that supports the hike again in May. But the balance of demand and supply is pointing towards disinflation over the course of this year. You have big energy-based effects to wash out. Monetary policy is that by now tight. Fiscal policy is by now tight. Producer prices have turned down a lot. And actually, money supply data, which had been the key leading indicator for the inflation even before the war, has normalized. And so I think we should just be a little bit careful. It's very hard on a monthly basis to calculate this stuff. And therefore, if the market's off by 0.2, 0.3, it's often not a big deal in hindsight. And we have had downside surprises before these upside surprises. So I think it argues for caution, let's go again in May, but it doesn't argue for worrying about persistent or sticky inflation just yet.
Callum, to ask you a question that probably seems completely inappropriate today, because today is about firming up expectations for a May rate hike. When do we get to cuts from the Bank of England? If we continue to see food price inflation moving at the pace that it is, and we do see cracks in the labour market, even if the wages story is much stronger, when do we get to the cuts part of the UK conversation?
Best bet would be in Q4. We can see some cuts from the Bank of England, but the Bank of England will be, even as it cuts interest rates, arguing that we're not going to cut aggressively. We're just going to go steadily. It's a normalization of interest rates towards longer equilibrium levels, which we think are around 3%. So our bet is 50 basis points in cuts in Q4, probably 100 basis points over the course of next year, and the Bank of England holds. The key point in all of this is that we've raised interest rates a lot, and every time I fly over Europe, I check out the window and I say, are the mountains still standing? The answer is yes. In 2017, the whole world was worried about the Fed raising by 25 basis points. What's going to happen? Now we can raise interest rates to 4 and 5%. We see that actually fundamentals are still good. And it's not just inflation and wages which surprise to the upside, it's output. The whole market, including us, has revised our forecast up since October because data has been better than expected.
Now, it's easy to see how in a sentiment sense, not a very quiet day, frankly, this story goes a bit global and people start to ask questions about sticky inflation globally. But there are some very specific UK factors at work here, I assume. I mean, European inflation has dropped right down. There's a lot of divergence within the Eurozone at 6.9% as a total number, and US inflation has dropped a lot further. So there are limits to how much this tells us about outside.
Still too high.
Yes, it is still too high. I agree with you. And I recall over the last few weeks heading into the supermarket and not being able to get basics such as salads and other food stuff. There were some weird idiosyncratic issues in the UK linked to food shortages. So that could be playing a part here. But again,
On a monthly basis, lots of things can move the CPI indexes. In the longer run, in the medium term, it's fundamentals. We know that over the next 18 months, the fundamentals are disinflationary. I think if you go even further out, it then starts to turn a bit more inflationary. We start to think about deglobalization, aging populations, fiscal policy still expansionary, especially in the US. Households are willing to spend some of these buffers that they built up during the pandemic. And so we start to be cautious around the inflation outlook. But I think we have to worry much less about where inflation is, say, a year from now, but worry a lot more about where it is, say, 4 or 5 years from now.
Is Brexit still a problem for the UK economy that other, that Europe and the US don't have to deal with? Is it still substantial?
It's a long-run friction. We've raised costs of trade with the EU significantly, but it's not the explanation for the upside surprises that we have now. I would not be surprised, actually, if the UK suffers more disinflation, say, next year than the US and the Eurozone. Partly as a bit of a compensation for what we see now, but actually because fiscal policy is tight in the UK, whereas it's not in the Eurozone or in the US. I would just make a bigger point here, which is to say, inflation is a bit of a sideshow. Just look how the world has changed. Central banks are raising interest rates. Economies are still surprising to the upside in terms of economic activity. But more than that, central banks are willing to give us recessions in order to normalize inflation. This is in complete contrast to the way the world looked after the financial crisis. My view is now the world looks a lot like it did, say, in the 1990s. It's normal business cycle dynamics. It's normal reaction functions by central banks. And these upside surprises in wages and inflation and in economic data more broadly are part of the fact that the world is just in a better place. Economies are stronger.
Speaking of sideshows, can we get a 2-box? Again, look at this.
I was going to say, you look fantastic.
You look amazing. I love your style, Callum Pickering. Thank you so much for joining us.
Thank you so much.
I'm glad you're both enjoying that so much. Yes, you both look fabulous. I appreciate the style that you both bring. Right, coming up on the program, Tesla is cutting prices again ahead of earnings today. Matt's mentioned this a couple of times. We'll get a preview of the results. They're due out later today. This is great.
なんでしょうね。はるかちゃんの留学のことかな。ライダー、明日もよろしく。JA バンク、明日も明後日も結ぶ。正解。ハウステンボスミッフィーセレブレーション。特別なミッフィーと一緒に可愛いで満たされよう。さあ、ミッフィーときめく2ヶ月間を。
This is Bloomberg's Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with the Ryanair CEO, Michael O'Leary. That's at 6:30 a.m. New York time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller, New York, with Hannah Edwards in London. Now, Tesla is cutting prices once again. That's the second time